Hello everyone. In this video, we are continuing with yet another activity. This is activity number 10. We are again going to do a full working of the consolidated statement of financial position. So without any further ado, let's get started. The final requirement is we're supposed to prepare the consolidated statement of financial position for the Pickering group for the 31st March 20x5. So here we are solving activity 10 together. Activity 10, and what we are doing is this thing. Now, let's read the information. Parent company acquired 70% of the share capital of the subsidiary on 30th of June 20x4 for $2 per share. At that date, the subsidiary had 2 million shares in issue. They had retained earnings of this much. Land and buildings that were shown in the accounting records for this much actually had a value of this much. So that means 3.2 million, but they were actually worth 3.34. So that means it's a gain of $140,000. On 31st March 20x5, the parent owed subsidiary 200,000 for the goods they had purchased from the subsidiary during February. 50% of these goods were still in the inventory of the parent on 31st of March 20x5. S company makes a markup of 25% on the goods that it sells. We are given with the individual statement of financial position, and the consolidated statement is what has been asked from us. So again, we will go in the stepwise working that we have learned as per the methods that have been taught in the ACCA Study Hub. So we will first follow the first step wherein we calculate the total of the assets and the liabilities. So firstly, if I want to calculate the total of my assets, tangible NCA, this is going to look like I will take the values as it is, 8920 plus 8920 plus I will take subsidiaries also 3780, and I will add to it the adjustment. We have had a gain of 140. You can calculate it. 3.34 minus 3.2 will give you 140,000 of gain. So this is what the tangible NCA will look like in the final statement. Then we can calculate our current assets as well as current liabilities. So liabilities, it's very easy. We owe within the group, the intergroup balances are existing. 200,000 is actually owed. So when it comes to the liabilities, 940 plus 410, 940 plus 410 minus 200, which are owed in the group only. So 1150 is what will the current liabilities look like. Now let's do the working for our current assets. So with respect to current assets, we will have our inventory also. And there was something which we have purchased from within the group, which is lying unsold. So we'll have to do that adjustment also. Firstly, we can add the total of the current assets, 1110 and 450. From this, I need to subtract the within the group transaction, which is 200. And then I have to subtract for the PUIP, the provision of unrealized profit. So what do I have to do? It has told me that 200,000 is what we owe. 50% was still lying in inventory. That means 100,000 was the value of the goods which are still lying in inventory. Right? This is the value of the goods which are lying in inventory. And the subsidiary makes a markup of 25% of the goods that on they sell. So the selling price will be equal to cost plus the markup is always put on cost. So that is 25% cost. So that means if I want to calculate the cost of these goods, it is going to be equal to 100,000 divided by 125%. So that is going to give me 80,000 as the cost. That means the profit is going to be the difference between 100,000 and 80,000. So that will give me 20,000 of profit, which is lying unrealized. So this is also something that I will subtract from my current assets in the form of inventory. So these are the balances. This is the first step that we have performed. Second step is we insert the share capital of the parent. So the share capital of the parent is directly given to us. It is 5,000. So share capital, it is going to be 5,000. Then what do we have? The third step that we are going to perform is going to be the calculation of our goodwill. So for the calculation of goodwill, I will again bring in the format from the previous question that we had solved. Let's do the working of goodwill over here. So let's first take up the fair value of the NCI that must be directly given to us. 70% has been acquired, land and building. So fair value of NCI, okay, we will have to calculate on our own because it's not directly given. So what we will do is we will first calculate the fair value of our consideration only. Consideration that we have to calculate, there are 2 million shares. I am buying 70% of these. So 2 million is 2,000 if I remove the three zeros. 70% of these and I'm paying $2 per share. That means in a total, I have paid these many dollars to get the controlling interest in the subsidiary. Then I will calculate the value of the non-controlling interest. 30% of the company belongs to the NCI. So 2,000 into 30% into $2. This is the value of the non-controlling interest. Now I will take the fair value of the net assets on the acquisition date. So on the date of acquisition, I will have the opening share capital. 2 million is the opening share capital that I have with me. Then I'm going to add to it whatever pre-acquisition profits were made and the adjustment for the land and building. So for the land and building, I had an adjustment of 140. I am first adding that. And then I will add the pre-acquisition profits. So for the pre-acquisition profits, let's see what was the amount. Um, the pre-acquisition profits were 1460. So I will add 1460 over here. This is the pre-acquisition retained earnings. Now I can calculate the goodwill at acquisition. Goodwill at acquisition will be the difference. So 400,000 is the goodwill that we have calculated. This is the third step that we have completed. Now we will move ahead to the fourth step where we calculate the value of the NCI. So for the value of the NCI, this is at the reporting date. So what was the value at the beginning of the year? Beginning of the year was 1200 plus the share of profits, which is after the acquisition. So how much is the profit after acquisition? Let's calculate that. Profit after acquisition is going to be what we have at the end of the year, that is 1820, minus what we had at the beginning of the year. At the beginning of the year, I had 1460. So this is the profit that has been attained after the acquisition has happened. So the subsidiary, the non-controlling interest is going to be the owner of 30% of these profits. So this is the post-acquisition profits that I have added to their share. Now I have to do one last adjustment, which is about the share of unrealized profits. How? Here, parent is owing the subsidiary. So that means the subsidiary is actually the one who is responsible for selling the goods. So subsidiary has this profit which is not yet realized. So subsidiary's profit has to be reduced. Whatever is the portion of profit, the non-controlling interest will bear their share of it. We will bear our share of it. So we had calculated $20,000 to be the unrealized profit. So of this part, 30% belongs to the NCI. So I will subtract 30% of $20,000 from their share. So this is what the value of NCI is going to look like. Let's make it 20 so that the numbers can work around. So 1302 is the value of our NCI. Now we will do the fifth step. Fifth step is where we actually work around the value of the retained earnings. So the retained earnings that we will calculate over here. So we take, what do we do for the retained earnings? We take the parent's retained earnings as it is, which is 6890. We add the post-acquisition share of the parent's profits. So the profit after acquisition has been this much. I take 70% of this value. So this is the profit after acquisition. And then I have to also take away the share of the unrealized profits. So the unrealized profits which are going to be there will be 70% of 20,000. So this is the value that we will show for the retained earnings of the consolidated group as a whole. Now we can draft our balance sheet. So for the balance sheet also, I will take the format from here. All right. So This format will ideally be given to you in your final exam because they cannot ask you to prepare the things from scratch. Tangible NCA, I have already calculated over here. This is the tangible NCA. Then for the goodwill also, I've done my workings. This is the value of my goodwill. Then current assets also, we've done the working at the very top. These are our current assets. Now we can calculate the total of our assets. Total of our assets are going to be the sum of all of these values. Then what we will do is we will come to the equity section. We will first input the share capital. Share capital was 5,000, which we will be taking as it is. Then we are going to proceed further. Is there any share premium given to us in the question? No. So we can remove this particular row. Okay. Next, we are supposed to take retained earnings. We have already calculated the retained earnings above. This is the balance that I will be taking. Then the total of my equity will be share capital plus the retained earnings. NCI also have also calculated here, 1302. This is the NCI. Then I will take the current liabilities, which I took at the beginning, this value. And now we will find out the total of the equity and liabilities. So it will be the sum from here to here. And this is how they should tally 14580, 14580. So this is how we work around activity 10. I hope that this video has been useful. Your doubts would have gotten resolved. If you have any other issues, any other queries, please feel free to reach out to me and I will see you in the next video.